Macroeconomic indicators. Why should we worry about what RBI is doing, where the GDP is going, or what's happening to inflation numbers, or what's happening to fiscal deficit? When we make our investment decisions, we need to remember that this is the macro or the top level, a high level set of factors that will impact our returns and the risk. So how our investments will behave, or what kind of returns we will get, or what kind of risk we will be exposed to a large extent depends on these macroeconomic indicators. The interesting thing about macroeconomic indicators is this, that there are economic cycles at play, or there are same factors which impact different asset classes differently. So when we build a portfolio, or when we want to allocate our assets and try and reduce risks, we have to bring these in. In financial advisory, we call this as tactical asset allocation. Let me give you an example. Let's assume that the GDP is going down. The news reports are saying that the economy is slowing down, or India's GDP, which was growing at 9% some time ago, is now growing at 5%. What does this mean? This means that the national income, or the rate of growth in the economy, is lower. Now, this also means that the return from equity markets would be down, because economic growth is down, consumption is down, investment is down. This leads to lower profitability, lower production, and lower expansion for businesses. Therefore, in an environment where growth is down, equity markets will be expected to do badly. But a low GDP will also mean policy will kick into action, because the government will come in and say for encouraging growth, interest rates have to be kept lower. So there would be RBI stepping in and providing an enabling environment in which they will start bringing the interest rate down, so that consumption, investment, they all come back. So a falling interest rate means that investment in long-term debt will provide higher return, because a falling interest rate will make existing debt instruments appreciate in value. So you have the same macroeconomic situation, but it is negative for equity, it is positive for debt. So when you find that the economic cycle has turned, you will find that tactically moving your money from equity to debt is providing you a better level of return. So you would sell off those equity shares, or you would reduce your exposure to equity funds, and you will increase your exposure to debt funds. These are not cause and effect straight line relationship, where you can use a very simplistic tool of saying when GDP is down, I'm going to sell equity. But these are good indicators to help you tune your portfolio, which is what we call as tactical allocation. So when you find that growth is coming down, you will reduce your equity exposure and look for the other signals that are there. Now, the reverse is also true, which is to say, when GDP is going up, let us say that year after year, quarter after quarter, year after year, you find that GDP growth is increasing. Now, this environment is positive for equity markets, because higher growth will mean higher expansion, better projects, higher optimism, higher profitability, higher revenue, etc. So a higher GDP environment will mean that equity will do well. But this expansion can create what the monetary authorities will call as asset bubbles, where people will start mindlessly expanding, or mindlessly using capital for projects which may not be viable. So what would happen? Very likely that monetary authorities will come in and increase the interest rates. So when they increase the interest rate, what happens? The debt markets which are impacted by an increase in interest rates, they start going down, because the price of existing bonds will start falling. Interest rates are higher than what they were before, so older bonds will lose value. So investors in long-term debt will lose value. However, investors who are in the money market, they will find that their returns are higher, because every time there is an increase in policy rates, the short-term rates will start going up. So if you looked at these three asset classes, equity, debt, money market, you will find that their response to macroeconomic indicators is not uniform. It is different. Consider a macroeconomic indicator like inflation, for example. If inflation is high, if you have a higher inflation, obviously the cost of production or the cost of capital for businesses will go up. So high inflation is going to be negative for equity markets. High inflation is going to be negative for debt markets as well. The interest rates will be increased. Increased interest rates will mean that bonds will lose value. However, high interest rates might be a good thing for money markets, because high inflation and high interest rates will mean that your return on your money market instruments, which are actually inflation neutral or which move in line with RBI's interest rates, they will start giving you better returns, which is also the reason why people tend to move their money from longer term investments to shorter term instruments. Look at the flip side of the story. If inflation were to fall, if inflation falls, it's extremely positive for equity markets, because cost of production comes down, cost of capital comes down. It's positive for debt markets because low inflation means lower interest rates and debt instruments start appreciating in value. But it is negative for money markets, because the rate of interest that you get in the short term is lower now. You were getting 8% when inflation was 8, now you're getting 6. So look at an asset allocation where you have some of your money in equity, some of your money in debt. Let's say you are 50% equity, 50% debt, and you're looking at an environment where you think inflation is going up. What are you most likely to do? Reduce what you hold in equity, make that 50 into 40 and move that 10% into money market. Reduce your debt from 50 to 40, take the 10% into debt. So how has your allocation changed? You are 40% equity, 40% debt, but 20% money market. This 20% money market is going to give you a return which is increasing with the increase in inflation. At the same time, it is protecting you from possible losses in equity as well as debt when inflation is high. This is what we call as tactical allocation. You know, you're not completely liquidating everything and moving from one asset to another asset, but you're saying, you know, I had 50 in equity, inflation is going up, which means profitability will come down, so I must reduce this somewhat. So from 50, you're bringing it down to 40. We call this as tactical allocation. In practice, tactical asset allocation decisions which are backed by some understanding of macroeconomic variables is a very useful thing to have. Let's look at an indicator like the deficit, the fiscal deficit or the current account deficit. Obviously, the word deficit means that we are spending more than we are earning, which is our fiscal deficit, or we are importing more than we are exporting, which is our current account deficit. So deficits in themselves are negative for equity market, because you know, international investors and international rating agencies, they might look at us negatively because they will see that we are living beyond our means in a certain sense, and particularly when these deficits come because of our high consumption of oil or high presence of subsidies, you know, those kind of reasons which several investors will see as something we should be controlling as a economy. However, so that will be negative, which means that high deficits will always be a negative thing for equity market. As far as the debt markets go, deficits mean that we are short, which means we have to borrow. So a high deficit would be negative because there will be supply. There will be supply of bonds, or there will be a requirement to borrow to meet that shortfall. So a borrower doesn't get a good rate, which means that the interest rates will go up. So these may be positive only from a money market perspective, because when the borrowing rate goes up, the money market rate goes up, the requirement for liquidity goes up, so short term rates might be higher. But an investor in the long term debt market or an investor in the equity market is going to get negatively impacted by the presence of these deficits. Obviously, these deficits coming down are going to be positive for both of this market. Now, while we are discussing these indicators, there are two ways of bringing them together. One is to list them like how we have done. These are just 3 that we have discussed. There are at least half a dozen more that you have to track. Look at how broadly we think directionally they will impact various markets. The other is to understand that there is an interdependence. A higher fiscal deficit will also mean you know, a higher inflation, because deficit in itself can be inflationary as well. And a higher GDP growth rate can also fuel inflation. So when we look at macroeconomic indicators, it's important to see that there are interlinkages, and there are also lead and lag effects. An increase in interest rate may not immediately translate into a lower inflation and therefore a higher GDP. It may take time for these effects to happen. Therefore, you can't oversimplify it by simply having a linear relationship between various macro indicators and the markets they impact. However, understanding directionally how these changes are likely to impact asset returns, they'll help us make practical decisions on the ground in terms of where our money should be there, and a good understanding of cycles. Many times investors ask for timing the market. They say, what's a good time to come in? What's a good time to go out? Now, that's not a technical decision, but it is a tactical decision which should be grounded on macroeconomic fundamentals. So, a good understanding of macroeconomics can actually help in these tactical decisions.